The slides are about raising a great Series A. Before we even get there, I think the most important question to ask is, should you even be taking venture money? And as a VC, you may say, well, this isn't talking your book, and the fact of the matter is there are tons of companies that shouldn't be taking in venture money, and at least at the very beginning, that shouldn't be the objective. The objective should be to build the best business you can that follows the founder's passion and mission, and at the same time where you've identified a clear market opportunity. Taking venture money brings up a whole host of issues that we'll touch on later that create a set of complexities that may not be appropriate or desired by the founders of the business. So for starters, if the business that you've contemplated isn't specifically targeting what is an extremely large market or likely to create a very large market, the idea isn't to sit there and try and dream something up just because there's a vast market. Does your business fit this criteria? If yes, then maybe taking venture is the right thing for you at some point. If not, that's totally cool. Don't force it. There are lots of other ways to do it, either via bootstrapping, friends and family, angel money, that don't come along with the burdens and obligations that come along with venture. The other thing is this notion of risk tolerance and building a business that really scales. Because once you take venture money, you're taking a lot of optionality off the table as it relates to either exit or building a lifestyle business. Venture investors get their money through exits, whether it's through the public markets or through M&A. And it may well be that you've come up with a great idea for a really value-accretive business that becomes a cash machine and is the kind of thing that enables you to have the life that you want, doing something that you're excited by, that just creates annuity income. That stream of cash flows does not subject itself well to venture financing, but is an awesome business. So again, if this is the kind of business that you've contemplated and that you've gotten up and running, don't force it. Now let's say that you, A, believe that you're tapping into a vast market, and B, you're all in. You want to go and try and build something of massive scale, massively disruptive, and you're going for it. Well, if you can't tell a great story, it's going to be very, very hard to convince a sophisticated investor to give you a scale amount of capital. So having that crisp narrative, and it's more than even just like the elevator pitch. This is something where if you're sitting down in a meeting with a venture investor, and they're sitting there, they're not talking, and they're looking at you like this, what comes out of your mouth? If you're stumbling, if it's not crystal clear to you why you're there and kind of how they can help you achieve this mission, then you're not ready. Doesn't mean that you shouldn't attempt getting venture money at some point, but it means that you're simply not ready at that moment in time. And then you really need to figure out, go back to first principles and say, why am I doing what I'm doing? Do I really have the market nailed? Do I really have a crisp product vision? Which is why you need to kind of go through this iterative process and make sure that you got it before you put yourself in that situation and look like an idiot in front of a VC, which is fine. I've done it plenty of times. But to the extent that you can avoid it, that's better. And then finally, and this is really challenging, especially for first-time founders, is having it's both the intestinal fortitude and the vision to actually see this business that you've created and you've nurtured to get to this point be a $100 million revenue business. But when you think about taking $8, $10, $12, $15 million, and that money is going to last you for the next 18 to 24 months, at which time you are likely to raise a Series B. But when you're sitting there raising the Series A, those investors still want to see that there is a very large business that you can foresee and call it a 5-year time frame. Now, clearly, if you are pre-Series A, you're going for your Series A, and you've got a model, no one is holding you to that model like that model's never going to change. We all know the compounding of error terms as you make more and more and more and more assumptions. But the fact of the matter is really understanding unit economics, really understanding how, if I put money in this side, my lifetime value to customer acquisition cost ratio looks like this, and this is how this business can scale by pouring fuel on the fire. Having a vision, understanding the levers, and being able to articulate that in a Series A venture pitch is very, very important. So I would say, if you don't have these 4 things, then everything I'm going to say is relevant, but you really need to be honest with yourself because, again, there is no glamour in taking venture money. It sounds cool. It sounds awesome. It can be the worst thing that you do if it's not right for you. Okay, now let's say, yeah, I got those 4 things. What do I need to look like to be a legitimate contender for raising a Series A? And I don't mean a Series A, I mean raising a great Series A. So when you start this process, you are highly likely to be successful. What does that mean? Number 1, multiple people want to do your deal. There is nothing like a competitive process in order to get the best terms. And I'm not just talking about valuation. I mean getting the best partner to help you build your business, the right price, not necessarily the highest price, the right price, and with a firm that has expertise in your domain where you can actually point to other investments they've made that demonstrate their excitement about the space so they're not just dabbling. Because sometimes you'll see firms overpay in a hot space just to get in that space. That can be fatal. Far benounced from you, this may be a test case for them. And if the partner that originally sponsored the deal leaves, but the firm itself is not committed to this area, then you're an orphan company, you're screwed. So extremely, extremely important to do your diligence on the VC. And having multiple offers gives you a much better chance of getting exactly what it is best for you and your business. And what I call fundraising without duress. Fundraising's hard, even in the best of circumstances. The greatest source of failure and actually either not getting financed or getting just atrocious terms is by doing so without enough cash on the balance sheet, without enough runway. So when we do seed deals at IA Ventures, we always capitalize a company such that they have 18 to 24 months of cash on the balance sheet in order to do what it is I'm going to tell you over these ensuing slides in order to raise a great Series A. Okay? If you are sitting there and you have 3 months of cash left and you need to raise a Series A or you're going to hit the wall, the best thing to do is to go back to your existing investors, try and negotiate some kind of a bridge because you're in a really, really, really bad place. So valuation in accordance with market multiples, this kind of gets to what I was saying at the beginning with the right price, not necessarily the highest price. And maybe at the end of this, if we have time, I can tell you some more stories. But it is really important not to assign a price to the business that is substantially ahead of where it is in its life cycle. Because most companies that raise Series A's ultimately want and need to raise Series B's. And if you've raised a Series A at completely idiotic terms, really, really high pre-money, really high post-money, and if you miss your plan at all, you're going to be staring at a down round. That is the worst thing that you can do to your company. It would be so much better to take a haircut to what a market multiple might be in order to put yourself in a position to be successful and knock it out of the park on the Series B. So again, what you should be optimizing for is a fair price, not the best price. You should be optimizing for the best partner for you and your business. Perceived as successful by key constituencies. In the earliest days of a company, the single most important thing besides raising money, is recruiting. And having a positive reputation in the market writ large, these constituencies, such that when people say, hey, so what about this company? People say, yeah, I hear they're doing really well. They're doing really exciting things. Like, you want that beneficial word of mouth. You want that excitement and buzz around the company. And if you're getting to this point to raise a great Series A, in all likelihood, you've done a pretty good job with this. You've been able to attract and retain great people that when you present the team to the venture firms that you're talking about for the Series A, you put them on that page shines. And it doesn't just shine because they've got great pedigrees. It shines because they're awesome, and you were able to sell them the story, and now they're integrated in the business and helping you kick ass. And then finally, this is this notion of raising enough money. So when we do our IA Ventures, we initiate all of our investments pre-Series A. So pre-product market fit, where there's early product, early proof, but where our whole thing is getting companies to this point. And that 18 to 24 months of capital, where instead of it being $1 million of MRR, monthly recurring revenue, that you would hope for, that the Series A is going to get you to, we're looking more for like 100,000 of MRR to then put yourself in a position to possibly raise a great Series A. So again, when you're doing the modeling and figuring out how much cash should you have, how much should you be asking for in your Series A, you should be thinking, I want to be roughly a $10 million run rate annual business, roughly $1 million in monthly recurring revenue. That would be a great place to be. Certainly businesses get financed at less than that, don't get me wrong, but if you're at this point, you're kicking ass, and you will absolutely raise a great Series A. Okay, so what do you need? So demonstrated product market fit. So as I said, what we do, which is the step before this, is helping companies figure that out. So clearly what a VC is going to do that's really excited about your business is they're going to call customers. They're going to call. Is that a question? Yeah. Okay. Yeah. I'm really new here, so sure. What is MRR? Monthly recurring revenue. And then ARR is annual recurring revenue. Month on month. Sorry, yeah, please. No. I'm 100% sure I'm using jargon and things that I take for granted, so please stop me at any time. This is a conversation. I just don't want to be up here bloviating. So again, so product market fit, they're going to call their own people. They're going to try the product. You're going to give them references. They'll call a few of those, but most of the stuff that's really going to be of import, they're going to do back channel. So really figuring out that you've hit on something and you've been able to successfully have that deployed at multiple customers at an increasing rate is of critical importance, right? If you're not at this point, and you need money and you've already raised a seed round, then you're talking about a bridge. You're not talking about a Series A. So roughly $100,000 of monthly recurring revenue. This is, for purposes of this discussion, I've made some enormous generalizations. Clearly, this kind of a number really applies to SaaS businesses, software as a service. So businesses that have recurring revenue or kind of subscription revenue bases. Not every business does. If you're doing enterprise software, it may be that you've got these big one-time large installs which constitute bookings, but that revenues are recognized over time, and then there's a maintenance component. So the character of revenue may be vastly different. So again, overly simplified, but if it's a software business that has recurring revenue, then once you get to about $100,000 and it's increasing 10 to 20% month on month, then you are in a good place to have a discussion about raising a Series A. Yes?
What sort of baseline metrics do you look at for consumer-facing apps like calendars, all these different apps that nowadays are sold for hundreds of millions of dollars
Yeah, well, we don't do shit like that because we don't understand it. I swear to God. Yeah, I mean, the stuff that's just pure consumer where it's really about installs and engagement, and really so I can tell you the areas that VCs look at. I can't tell you what the metrics are because we just don't really do that. You know what? We actually have a company that's actually kind of like that, a company called XAI, which is the artificial intelligence calendar scheduling company that is absolutely, in terms of pure heat, the hottest company in our portfolio. Revenue, 0. User base, skyrocketing. And so there's certainly installs, right? But then much more important is engagement, right? So active users, and then there's time spent per day, per week. So it's, as you think of the funnel, you can have a huge amount of installs, but if you don't have the statistics to show that people are actually using the service, then it's worthless. And we've seen have been tons of these flash in the pans businesses that have gotten 10 million downloads, but the engagement's super low, and then they just go away. But something actually like XAI, the persistence and the level of engagement is stratospheric, which is why it's so hot. So again, in general though, that stuff scares us. We're not smart enough for that. Okay, so data indicating that the market opportunity is vast. So we've moved beyond just storytelling to empirical evidence. It could be everything from your own market research. It could be independent third-party research, and there's a ton of it out there on sizing markets with competitive landscapes, but something that shows this product is attacking that, or it's creating that with actual numbers to substantiate it. It's either a bottom-up build, if it's something where, wow, we've really struck a chord and we're actually creating something new and distinctly different, or, hey, there's this huge, inefficient market over here, we're attacking that. Here are the revenues currently attributable to that market. Here are the players, here's how they price, and here's how we're going to crush them. So it's kind of boiling it down into much more tangible, much more concrete numbers. High retention and low churn. So if you're talking about a subscription software business, then this is absolutely critical. If you figured out how to sell it, but not train people well enough to use it, or it's so simple and straightforward, and the materials, the online materials are good enough that people can just kind of get productive super quickly, then you're going to have a hard time raising money. Because, again, this is beyond the seed stage, right? This is people are ripping it out of our hands, and they're actually using it. Absolutely, absolutely essential. There's nothing worse than a high churn rate that you can't explain well to kill a Series A. Early proof of increasing customer spend. So especially in today's world of software as a service, the ticket price for a single unit is very, very low. That's the whole point, is to keep barriers to adoption low. Sell from the bottom up, right? So these generally aren't sales into the CIOs. These are generally sales into specific business units that adopt it, and then you hope it propagates. You know, something like a Slack is a great example of that, or a Zenefits. You know, you start out with one and you end up with 1,000. So this kind of land and expand model is very, very, very popular, very easy to capture metrics, and what a Series A investor is going to look at is, hey, okay, so you've been able to get this in 100 companies, but have you been able to go within a given company from 5 seats to 50 seats? Can you upsell effectively, both from a cost standpoint, because when you're selling, right, there's outside and inside. Outside being a direct sales force, which is what sells traditional enterprise software, very, very expensive. Very expensive, longer sales cycles. Inside sales, telesales, online, search engine marketing, search engine optimization, much more cost efficient, scales much better, but the fit and fitness of the product has to be insane for it to be sold in such a light touch way. So it's kind of balancing those two, figuring out where you sit, and demonstrating that, yes, regardless of whether we're using forward deployed salespeople or an inside sales force, that we've been able to ramp sales within accounts. Super, super, super important. And then finally, team. I mean, I put that at the bottom. It's clearly not the least important. This is not in any kind of importance order, but by the time you get to a Series A, you want to have, a compelling founder CEO, a strong CTO or VP engineering. You're going to want to have a strong head of sales. And from there, it declines in importance, but you really need those three for starters. And depending on the scale of business, I mean, you could have 15 people where you've got, you generally don't have a head of operations, but sometimes you have a CTO or chief architect and a VP engineering. And in software businesses, that tends to be super, super important. You generally don't have a COO at that point, but you might have a director of operations, somebody that helps the CEO with the nuts and bolts of finance and ops and helps build the dashboards for KPIs and kind of metrics monitoring across the business. But fundamentally, those core 3 or 4 people are going to be essential for selling yourselves to a venture capitalist. So what can you do to hit these milestones? So something I've talked Nancy's ear off about a ton, and something that we do at IA Ventures is this notion of a hypothesis exercise. And we believe it's critically important to be absolutely crisp on what it is you're trying to prove with this check and what the measures and metrics are that would serve to validate that, in fact, those hypotheses are true. So there's very structured thinking. Because if you go into a meeting and you've done this thinking, you are going to impress the hell out of whomever you're sitting across from, because most companies don't do this. They have bits and pieces of it, but they don't do it in this extremely detailed, structured way, and it's a great way to do planning. So being able to tie these big headline goals that the company has to very specific quantitative targets, and being able to measure and report on those targets and collect the data and be able to show this data to a potential investor is super, super valuable. Again, this kind of preparation, this kind of deep knowledge of your business is, again, at this stage, I would say unusual. And when you see it, you're blown away. So that's what this is all about, is helping you folks blow it away when you're sitting in this situation. Having experimentation at the core of founder DNA there's nothing sexier. There's nothing sexier than a founder who thinks in terms of a series of experiments. They run constrained tests, they collect data, they iterate, and they do so very, very rapidly. I can't tell you how many companies, first-time founders, will test without being incredibly crisp about what they're testing for, and then being really great at data capture and really understanding if the test has been successful or not. Again, this sounds like basic stuff. It's not. Trust me. When you're in a startup, some of you may have already worked in startups or had your own startups, it's a 5-alarm fire every day. It's always stressful. It's always crazy. There's always way too much to do. So oftentimes, unless you stop, breathe, and think, you can just be doing and not thinking. Because doing feels good, right? You're making progress. You're making headway. But unless you've really taken the time to create these very structured tests, these very clear experiments, then a lot of that work is going to be for naught. So founders that have that in them and have demonstrated the ability to do that and to actually ship software that way is so attractive. embracing collisions with the market. There is nothing scarier for a technical founder than actually releasing a product and having people say it sucks. It's the scariest thing in the world. Take an awesome engineer. They've built great code. They think it's going to be attractive to this customer. But wait, let me fix this. No, let me do that. They're afraid to release. They're afraid to ship because being told something doesn't work, isn't what I want, why doesn't it have this, it is too much of that, it's too hard to use, is very demoralizing. If you're going to be running a startup, you're going to be in a startup, you can't have that attitude. You've got to have really thick skin, and you want to get market feedback as much as you can. It doesn't mean they design the product for you, but it means that you want that input. In the same way as when you're raising money, you want to talk to an array of VCs because you want to talk to a bunch of smart people and get different lenses on your business, because each time you have these conversations and you have to pitch it, you get better and you're learning new stuff. It's the same thing with releasing early and often, is to get that feedback. So extremely important not to be afraid. And again, the data capture of getting quantitative feedback is extremely important. And which serves to prove the last one, which is this just an environment of experimentation, rapid release, and a data-driven decisioning. Really, really, really valuable, and will help you hit those milestones that I talked about on the prior page. So somebody sitting in front of me, one of my partners, or pretty much any VC in our orbit, what is super exciting? Crisp vision. This gets back to that very, very first page. Can you articulate a narrative? Can you tell a story that's compelling? Clear vision, clear mission, team on the field to do it. We've got early proof that we're the right people, this is the right product, and this is the right market, and the time is now. So it doesn't matter how technical you are, you need to speak well, speak confidently, speak with authority, and know your stuff. A clear value prop. Again, and I find this tends to plague insanely bright people, is they make things more complicated in the explanation. They know it inside. They make it more complicated than it is when explaining it. If you don't have the ability to talk about what the value is in 30 seconds in plain English, you're not ready. There is nothing more frustrating than sitting in front of somebody who has a really good idea and has built some really good stuff, but they can't explain it well, because the founder CEO, like, they should be the best salesperson in the company. Always. Always, always, always. And if they're not, very scary, because not only do they sell to customers, they need to sell to potential recruits. It's the same thing. When you're recruiting somebody, if you can't crisply tell the story and get people fired up, they're not going to come work for you, because great people have loads and loads of options. At that stage of a company, they're not coming because you're paying them so much cash, and yeah, you're giving them equity, but, I mean, the value's in the future. They've got to believe in you and believe in the vision. And unless you can sell them, they're not going to come. And then you're going to suffer from adverse selection. Data-driven decisioning, informed by customer interaction. Yeah, I've already talked a lot about that. It's just, to the extent that you can instrument stuff and you know your numbers really, really well, super, super appealing. Emphasis on user experience and ease of adoption. It's so hard to make something that's very technically complicated seem like where that's all abstracted away. So to the user, it just works. That is absolutely critical, because to the extent that you're looking to not do the forward deployed Salesforce, the heavyweight enterprise sales model, you want to do something that's lighter weight, that product, regardless of how complicated it is, needs to seem really simple to the user. So getting people with great UX, UI experience involved early, great design experience, will pay off in spades, which is why I'm so excited about SI, because I think the skill set of folks in SI is extremely well tailored to not just where the world is today, but where the world is going, because it's only moving more in this direction. Command of the numbers, absolutely. Especially now, there's so much material out there on subscription software businesses, on how to look at them, how to analyze them. There's the, probably the most famous was Bessemer Venture Partners put a report together on SaaS metrics that, all of you should read. It's on the net, super easy to find. That talks about how to, what are the metrics that matter to SaaS investors? And knowing all of that, going into meetings and saying, well, our payback period is currently 13 months. We know that that's too high, but it's gone down actually from 16 months to 13 months, and here's how we're going to reduce it to 6 months. And, so right now, we've been looking at an 18-month LTV, but actually we think with new products, our LTV is going to go up by 50%, and this is how it improves our LTV to CAC ratio. Just having a facility with these metrics and understanding them for your business is going to be very, very impressive and is essential to be perceived as an A-type SaaS investment opportunity.
What's LTV and CAC?
Yeah, lifetime value, and it's basically cost of customer acquisition. And then lastly, which is funny, because we've talked so much about being structured and being defined and knowing your numbers and being crisp. The final thing is actually unbounded orthogonal thinking. So you think, well, how do those things fit? Well, there's two parts to a business. There's the vision, and then there's execution. You need to prove out both. You need to show that we have a secret. We know something that other people don't. That's why this is such a compelling investment opportunity. That's why we've devoted our lives to this right now, today. That's a really hard thing to get across. And it's a really hard thing to sit in front of somebody that's seen 1,000 deals in your space, and you're like, we're different. We're different. People are different, ideas different, we're different. You know what? You got to sell that. You got to feel that. If you haven't done the work to feel that, and if you don't really feel that, then you can't sell it. But having that ability to speak authoritatively about why you're different, what your secret is, and the fact that, and you know what? People currently see the opportunity like this. Actually, it's not this, it's that. That out-of-box, out-of-band thinking, those are the kind of founders that generate multi-billion-dollar outcomes. Those are the kind of founders that venture investors want to back. However, you can have all this, but unless you can do that, you're screwed. We all know this. Great ideas aren't worth anything without great execution. It's just the way it is. At least with great execution, you know you're going to get an outcome. It may be a small outcome, but you're going to get an outcome. If you have great vision and crap execution, you may get to the Holy Land. You're more likely going to be a zero. So the reason why I'm emphasizing on all this earlier stuff, the kind of the metrics focus, the hypothesis testing, the structured thinking, this is all around the issue of execution, because looking at the people in this room, I'm sure that we've got many super creative lateral thinkers that will be able to articulate a very compelling mission. I'm sure of it. You wouldn't be here if that wasn't the case. U of M is filled with super smart creative people. To execute well is really, really hard. extremely hard. So I figured if the amount of time I have to speak is X, I want to spend 80% of X talking about the execution stuff, which is the stuff that you're not learning really in the classroom, right? You're learning tools. This stuff, how to actually sell a VC that you rock and you're special and they should be investing in you, that's really hard. So that's what I'm trying to bring to you today is peeling back the covers. The person on the other side of the table, what are they thinking? How are they looking at you? You know how they're looking at you? Like all this stuff I just told you. That's what they're thinking. So you need to be prepared for that so when you go in there, it's not shocking. It's just, I got this. I got the vision, but I've also set up the execution piece for success. That's it. I am happy to answer questions. Yes?
Sorry about that.
Me too.
For portfolio companies to show their early employees the term sheets. I'm asking that because I agree that recruiting top talent is really important, but as an early employee, I like to know if there's going to be a liquidity preference or anything like that that could affect my equity, and I think that's important for early employees to be diligent in that way.
So is that a question about whether our...
Like, do you encourage your companies to be open with their term sheets?
We don't. We neither encourage nor discourage. That's a founder-specific, culture-specific thing. And we have some companies whose founders believe in hyper-transparency, and we have others that, no, like, we got this, and they disseminate information enough so that people understand broadly, but not specifics to that degree.
Thank you.
Sure. Yes.
Great talk, thank you. You mentioned a lot about execution is hard. Do you see from these founders that this is the execution part is associated with some personality traits that either is natural or could be exercised later on?
That is an awesome question. So did everybody hear that question? Yeah. Okay. So the question was, the kind of skill and execution. Are there some common personality traits of those who execute well? And the answer is, there tends to be intense self-awareness. That's number one, because not all founders are necessarily great execution people. In fact, I'd say most of our founders are shitty execution people. But they have co-founders who are awesome execution people. But where you get into problems is the dissonance of, I suck, but I think I'm good. Or, I'm the CEO, I got it. That's fatal. Absolutely fatal. So, great founders are super self-aware. The best founders, the absolute best founders, have both. They're self-aware and they're detail-oriented, and they recruit great people to help augment their weaknesses on the execution front. So we have a range of founder CEO personas, but they all are very self-aware, and whether or not they're effectively the CEO, COO, or they're the CEO, chief evangelist, and then they've brought in a COO or have somebody in the company that's focused on the nuts and bolts and managing the details, it varies. Yes?
You put a lot of emphasis on early iteration data capture, especially during the product market fit period. For a lot of us here that are students, especially working even with a strong technical team, especially with iteration cycles, going back to the sort of development team and saying, hey, we need to change this, meeting sort of skill constraints in this context because they are still students. How do you overcome that?
I have no idea. Yeah. Yeah, I mean, well, one thing I'll say, and this is not directly responsive to your question, but to the people that you're using to help code stuff, have they spoken to customers? They have. So they're kind of engaged in the product development process as well. It's not like that's, okay, that's great. As for how you're getting incremental resources, that I have no idea. Sorry. I'm sorry, there's a question way back there.
Yeah, so if you're that first type you were talking about and your big picture, right, whatever, how do you find someone who is detail-oriented when maybe details aren't interesting?
So generally, in general, number one, they come to the table with somebody they've worked with in the past that serves in that role. Number two, they will leverage the networks of their friends and their investor partners to help identify somebody who has this skill set and then brings them in as a co-founder title, but with less equity, significant equity, but less equity than actually if they were a day one co-founder of the business. That's hard. I mean, generally the personas we see are either more business-oriented founder needs technical co-founder, where the business-oriented founder is more detail-oriented, or a highly technical co-founder who's also detail-oriented, who wants somebody who's more sales-oriented. I don't know if I've ever seen a company or that we've ever backed a company where it was a non-technical founder who themselves isn't detail-oriented. We do not have that in our Venn diagram. That's just so somebody who's just like a pure idea person, but who's not technical. Yeah, we've never seen that.
Sorry. The point was that like you can be technical without being detail-oriented, as in like understand the technology,
Oh, yeah.
the technology, what's going on, but not like how are we going to pay these people, and what's the best way to hire, and business.
Right, and that we do that every day. So like we'll seed somebody like that, but then at the part and parcel of our investing is helping them recruit a more business-oriented co-founder.
Have VC or like private markets changed in any big way since you started?
Yeah, well, I mean, if you go back to when I first started doing early stage after I left Wall Street in late '04, I mean, there was no such thing as micro VCs. There was no such thing as angel list. There was no such thing as crowdfunding. The growth equity business was a fraction of the size it is today. It doesn't look anything like it used to, which is ironic considering that my firm is as close to an old style VC and venture model as it could possibly be. It's like as the world's going here, we're going in that direction. 3 partners, do our own work, no junior people, artisanal, no platform, not a billion services, just artisanal VC. While everything else is kind of, you've got the first rounds and the Andreessens, and you've got this huge explosion of kind of seed funds and emerging managers. It's a very loud landscape right now. I think, as in most things, there's going to be a tremendous shakeout, and there won't be a lot of fund twos for a wide swath of the seed funds that have been raised. And with the exception of First Round Capital, who I think has done an absolutely brilliant job building a true platform that creates community and network effects, I think the dabbling that many other firms have done, that will all be shut down. That's my view.
Thank you.
Sure. I guess there.
I have 2 questions. Right, so the first one is, how much do you expect the founder to be invested in? So let's say you're really low on capital. I mean, so would you expect the founder to invest his own money?
No.
The business?
Most of our founders have no money. Oh, because we've I mean, as a new-ish firm, we generally are backing first-time founders. And those who are repeat founders that will then come to us for seed financing, yeah, they will have kicked in a few $100,000 of their own money, but they have a few $100,000. The lion's share of people we're backing don't have shit. So we don't expect it.
So my second question was, again, I thought initially that the Series A funding was the first line of funding, but so how do I mean, as a founder, how would you expect to gain the initial money required to recruit people or build the team and stuff like that? So is that not with the VC?
No. In general, no. I mean, right now, and this actually gets back to the question that this gentleman commented about how the market's evolved. The Series A is now, I mean, we don't even like to use letters, and I apologize for framing this whole thing as a letter. It's something that people understand. Series A, I kind of know what that means. The reality, and it used to be that all venture capital started here. Right now, this is the third round of funding. There's friends and family, there's seed, and there's A. So friends and family is where it's like angel money. Could be some friends, could be parents, could be retired executives that like to put money to work. Kind of traditional angel financing is in that kind of friends and family. Then you've got seed. Because of this proliferation of institutional seed funds, there are now tons of firms that are writing, $250,000, $1 million checks into companies to prepare them for this. Because a Series A is now like an $8 to $15 million round, right? It's not a $5 million round, which is what it used to be. So everything's kind of been skewed up. So it's really kind of hustling in the community and tapping your friends and family to try and get a little bit of money to get the thing off the ground. Yes?
Hi. So as an experienced entrepreneur and with Wall Street experience, what has been your biggest either failure or area for like learning experience?
Well, certainly in terms of my experience as a VC, having my own venture-backed startup and failing was tremendous learning. I mean, it sucked. But it was, I mean, the learning was invaluable. I mean, it really changed. I was a very, very, very successful angel investor. I mean, very successful. But you don't have the empathy for a founder until you've been a founder. And having been a founder now, and now being on the other side of the table, it's given me an invaluable perspective and a much better sense of the gotchas, like all the stupid things that I did that I now look for and specifically advise companies, whether I end up investing them or not, but just in my mentoring and when I meet companies, I will absolutely positively advise them on these things. And so that failure has been easily the most valuable tuition I ever got in the realm of VC. Sure. Yes?
When it comes to investing, what are the major or biggest differences between like high-tech hardware and software versus the daunting startups?
So hardware is, I mean, I'm just trying to think of it's an order of magnitude more complicated because you not only have the design and engineering and prototyping, you also have the logistics associated with procurement. So all that whole fulfillment piece, which is a skill set unto itself that is generally not known unless you've done it, and you can try and gain the experience. I mean, super smart, motivated people figure this stuff out. But it's insanely painful. And the other thing is the kind of the MVP, right? The minimum viable product tends to be much higher when you're talking about producing a thing. And as a result, the amount of money that you need to raise is generally much greater to prove out if you've even got something. So like for someone like me, with me and my partners, you know, with a, whatever, we just have been investing out of a $105 million fund, that doesn't really subject itself well for hardware investing. You really need a bigger bankroll, like probably at least a $250 million fund, because you need to be prepared to write $5 to $10 million initial checks to even turn over the cards. Even in today's world of, you know, low cost and offshore manufacturing, it's still really expensive to actually achieve product market fit with a device.
Okay, time for one more question, I think. Then I gotta give Roger a little break here.
Sure.
So you mentioned the horror stories associated with people who accepted venture capital money that should not have. Can you give an example of one that sticks out in your mind that you've seen occur?
No, the horror stories more relate to companies that have taken venture money at prices way, way, way too high. That's been where there have been horror stories where, sure, where they were great at fundraising and they were able to generate the excitement and sell multiple VCs on the opportunity, and as a result got term sheets that were easily 2x, if not more, overvaluing the company relative to its peers, such that when it came time to raise the next round, they looked like crap. Because even though they'd made good progress, like good progress for a company of that age and stage, the price expectations have been so mismanaged that it basically the fair round would be a flat round. But a flat round is failure. So you get caught in this vicious cycle because a lot of VCs will simply just say no. Because even though they think the business is good, because of the precedent that was set in the prior round, they're unwilling to be the bad guys to say, well, we'll do a flat round. So they just walk away. And you're like, but it's a really good business. But they don't want to be associated with screwing the entrepreneur, so they're stuck. So you could have a really good business that is not financeable because of the expectations that have been set, because of an overpriced prior round, and then the company has one choice, and that's sell, which is a tragedy, because no one will fund it. I've seen these really crazy situations. At the same time, I've seen some very mature founders that had these opportunities that have turned down literally unbounded offers from top VCs who just were crazy hot for the company and have taken offers 50% lower. 50% lower from a super high quality partner of a great firm that they felt would help them build their business and not set them up for failure in the next round.